Hello, everyone. Happy Friday. It's Friday, July 15th. This is the final bar. We're going to talk about the S&P closing at the highs of the day, finishing the day up almost 2% to 3860 underneath the hood. That's where the stories really have been. Financials raging back to the upside with the XLF up 3.5%. A lot of individual names like Citigroup, State Street, Wells Fargo having pretty decent days, but it doesn't really change the trends we've been talking about. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. Happy Friday. I'm Dave Keller. I'm the Chief Market Strategist here at StockCharts.com here in a very sunny and warm Redmond, Washington. Thanks for joining us every weekday after the close, but especially on Friday as we try to make sense of the week that has happened, try to focus on some of the key charts as we address the markets from a number of different approaches and try to think about the key metrics that help us understand the evolution of these markets. You know, when we're looking at market analysis, I tend to think of it in a couple different time frames: price and breadth and sentiment, and focusing on those different components to it. What we will see is some nice short-term positive price action, nice bounces from financial stocks, even Netflix up 8% today, Penn Gaming up almost 8% as well. These are nice moves. The problem is when you're coming off of a pretty beaten down level, up 8%, but still down 40%, you're still down 40%. I think that's the challenge for a lot of these names. These are rallying off of fairly low levels. Have they really regained the levels of resistance, those key swing highs that tell you that an uptrend is actually occurring? Not really. You need to have follow through going into next week. That's why a day like today is interesting, but it doesn't tell you the entire picture. We need to pay attention to what's happening in the week to come to see if we validate that potential for further upside. A lot of great charts to refer to here through the course of the show. Wanted to share with you the schedule coming up. We had some really cool conversations. Had a lot of fun talking with Carolyn Barodin yesterday on Fibonacci analysis on the major averages. Next week, on Tuesday the 19th, we have Jay Soloff from Investors Alley. On Wednesday the 20th, Todd Zone from Strategas in New York. Coming up next Thursday and Friday, we have some special programming for you in this time slot. We'll talk about trend lines and dig into some of the best practices of applying trend line analysis. Really important right now when you have some rallies, but they haven't really broken trendline resistance yet. And then on Friday, we'll talk about the benefits of learning about market history. Let's continue on today's show with our segment called Wrap the Week. This is where we focus on the last 4 to 5 trading days. We'll focus on the trading week. What has really materially changed over time? We'll get to some charts that tell that story here in a moment. But I did want to start with a poll. We always have a poll running on our live stream page. That's at StockCharts.com on the TV page. Also on our social media accounts. So follow us on Twitter. Also, make sure you subscribe to our YouTube channel. We asked you recently, what would you feel most comfortable shorting right now? Stocks, the S&P 500, 27% said that one. Bonds, TLT, 15% of you. Gold, 11% said you'd be feeling most comfortable shorting gold. Almost half of you, the big winner, 47%, saying you're most happy or most comfortable shorting Bitcoin. That's a really interesting question. I love it. It flips it over, right? When you talk about what would you most want to own right now, has you approach things a certain way. When for me, I don't short stocks very much, and I really don't use inverse funds very often. So shorting is sort of a scary, mystical approach to betting on downside. It sort of flips the tables, and you have to think about potential downside. I would 100% agree with the idea of I would probably vote for either stocks or Bitcoin. And given the choice, I probably would go for Bitcoin. And I'll tell you why. When we're looking at the chart of Bitcoin, it's had that stepwise motion, right? Sort of we go down to 40,000, we consolidate. We go down to 30,000, we consolidate. We drop. We get to 20,000. We've been consolidating here. I'm going to assume that pattern continues until it's exhausted. And I don't see downside exhaustion yet. I see in the short term, it stopped going lower, and that's encouraging. But the problem is I've seen that sort of consolidation pattern a number of times in the last 6 to 12 months. Pretty much all the times it's resolved to the downside. I think a chart like Bitcoin has a lot to prove before it shows as a positive. Now, if half of you are thinking you're most comfortable shorting Bitcoin, what does that tell you about other risk assets like stocks? I would argue that's probably not a great sign for the equity markets. Is that's what we're leaning to. Great. Thanks again for answering our poll. Keep your responses coming when we send that around. As we wrap the week here, the second thing we like to do is look at the wrap the week chart. This is a classic chart I like to use, just showing the returns and the major averages over the last 5 trading days. We had a holiday before, so I have to bump this back a little bit. There we go. Now we are starting the clock on Friday, July 8th. We're going to where we're at today, end of day Friday, July 15th. What has happened in the financial markets over those 5 trading days? So the S&P finished with a nice rally today, down almost 1%, just under 1% to the downside. A number of things underperformed the S&P this week, very slightly. We had the NASDAQ 100 down 1.2%. We had small caps, the IWM, which is the Russell 2000 ETF, was down 1.4%. Below that, gold and Bitcoin were both right around 2.1% to the downside. In orange, emerging markets down 3.6%. And then in brown, we have crude oil prices down 6.1%. That's using the USO, which maps pretty well to crude oil prices if you look at the crude oil future. Only a couple things outperformed stocks and were actually positive on the week. This is the US dollar index up 1%. In red, we have bond prices up 3.25%. These are 2 really interesting charts to think about, or returns to think about. Think about the dollar. Someone on social media in one of my accounts responded to a chart that I'd sent around and called the dollar the wrecking ball for risk assets. That is a really interesting and fairly accurate way of thinking about it, right? In the short term, look what's happened. Pretty much everything's been down except the dollar has been raging to the upside. So it's up only 1% this week, but it's up significantly year to date. While most things have been struggling to show any sort of upside follow through, the dollar has been continuing to do it. So sort of like everything down except for the US dollar. Bond prices having the best week of all of them now. And I think one of the pain trades to think about as stocks has stabilized, you have a day like today where Citigroup and JP Morgan and some of these other names, Netflix, are up 8 to 10%. A lot of people buying in on some short-term optimism. However, what if this is the pain trade? What if bonds continue to go higher? What if rates come off and everyone's rotating out of risk assets in the next couple of weeks, which means bonds start to work, rates come off a bit, stocks really start to come down, cryptocurrency start to come down. That is a very real scenario I could see playing out here. You'll know that that's happening because the chart of the TLT will rotate to the upside. And a lot of these other things we've talked about, like the S&P, the NASDAQ, and a lot of those individual names will be more at the lower end and will break and fail to hold support. So an interesting potential narrative to be thinking about here over the coming days and weeks. Just really quickly to touch on what happened today on Friday's session, the S&P with a really nice day, moving to the upside almost 2%, just around 3860. The NASDAQ up a little bit below that, mid caps and small caps all up around around 2%, we'll call it. The VIX coming off quite a bit now, below 25, which is interesting because 24 is where the VIX bottomed out the last time we had a rally in stocks. And then we rolled over is right around current levels. So something maybe to watch going into next week. Today, you had bonds rallying, interest rates coming off, the dollar coming off as well. In the commodity space, everything but gold had a pretty decent day today with the DBC, the commodity index, higher. Cryptocurrency is doing pretty well here on Friday with Ether getting above 1260 and Bitcoin back above 21,000, which is actually pretty much at the upper end of this little range that it's been in here in recent history. On a sector basis, financials with all the wins and earnings, you had Citigroup, JP Morgan, Wells Fargo, all reporting earnings, State Street, all moving nicely to the upside today for sure. Followed by communication services, a bit of a risk on feel to today's action. And the most underperforming sectors, utilities and consumer staples, the outliers to the downside. So for one day, very much a risk on fuel. And that's following through yesterday, which is a nice sort of push to the upside. So stocks a bit of a move to the upside here to finish off the week, which is a nice way to take to finish the week. We'll take it, right? Let's go to the Mindful Investor Live chart list to finish off our Wrap the Week segment. We'll start with the market trend model. As of today, even with the rally, it's not enough to turn or to keep the short-term model from turning back negative. This short-term component has been super noisy. Basically, in the last 4 weeks, It's gone back and forth, bullish to bearish to bullish, back to bearish today. So I haven't updated that label, but I will do it here shortly. So for me, all three timeframes, long-term, medium-term, short-term, bearish according to my market trend model. It's based on weekly data and exponential moving averages. The daily chart of the S&P looks like this. I had a great conversation with Carolyn Borodin on yesterday's show. If you missed that, go to the episode on StockChartsTV.com. You can see some of her comments. She had a lot of really particular levels she was looking at for the S&P and also for the NASDAQ 100. When I'm looking at the chart of the S&P, what strikes me today is just this consolidation, right? You've sort of been bouncing around lower highs, higher lows. This is a market that's essentially in equilibrium. The way that I would describe what this market has done, the big leg lower, April to mid-May, sort of the 6-week period of going lower and lower. We bounced off of a key Fibonacci support level. From there, I would describe the bounce off of 3,800 and then sort of this revolution, this pendulum swinging above and below 3,800. This is still all about that level. I think the market and investors psychologically have keyed in on that point. We have sold off to that point. We've given back 38.2% of the overall rally from March 2020 to January 2022. And now we basically, for the last 10 weeks, have been bouncing off and now rotating right around that level. We are at a point of equilibrium. Everyone's sort of in agreement that this is where the S&P should be. And now we're just biding our time for one side to take control. Either buying power overwhelms the demand, the need to sell shares, or the selling pressure overwhelms any potential buyers. One side takes control and breaks things out to the upside or the downside. On individual names like Apple, we have a clear line in the sand, 150. You get above there, that tells you the buyers are clearly taking control. With a lot of the banks that have rallied, I think you see that too. With the S&P, you have that as well. I think you get above 3,900, 3,950, get above the 50-day moving average. This is clearly resolved to the upside. There's more upside to this move. If we fail here going into next week and start to rotate back to the lower end, I think this starts to set up for a rally in bonds potentially and a potential drop in equities going into next week. Let's look at breadth here very briefly. The advanced decline lines for the New York Stock Exchange for the large, mid, and small cap universes, all sort of still very much in a downtrend. Now, these are not quite updated for today's close, I don't believe, as I'm looking at the data. So here we have the advanced decline lines as of Thursday's close. And if you look, the advanced decline line for the New York Stock Exchange made a new low for the year on Thursday. Same for the mid cap measure of breadth as well. So 2 of the 4 making a new low for the year in this week. You did not get that in large caps. You did not get that in small caps, but 2 of these 4 making a new low. And the most important one in my mind, and it's not even close, is this first one, which is looking at common stocks on the New York Stock Exchange. The fact that that's making a new low is not a bullish sign. That's a bearish sign. As of the end of the week, just to finish off our wrap the week segment, you had a nice bounce here at the end of the week. It's still less than 3 in 10 S&P members above their 50-day moving average. For me to get excited about the S&P, we'd have to get back above the 50-day. For me to get excited about a lot of individual names, we'd have to have enough of a rally to get above the 50-day moving average. For 7 out of every 10 S&P stocks, that is not the case as of today, as of Friday's close. Let's take a quick commercial break. We'll be back with our next segment, Power Up. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thanks for joining us every weekday after the close as we break down the activity in the markets using the technical analysis toolkit and the power of stock charts. We have such a powerful platform to help you understand what is happening in the markets around you, help you make better decisions, hopefully empower you to improve your understanding of investor psychology and behavior and manage your own emotions as you're making buy and sell decisions. A lot of great resources we have on StockCharts TV and on our ChartSchool platform on StockCharts.com. I hope you're taking advantage of all of those things. A couple quick announcements before we get to my next segment. First off, we welcome your questions. We're going to do a mailbag segment here in a few moments, and we would love to feature one of your questions in our next mailbag segment early next week. You can get your questions to us one of 3 ways: via email, thefinalbar@stockcharts.com. On Twitter, just tag us in a comment @FinalBarSCTV. or on our YouTube channel, just put a comment below the video you're watching on our StockCharts YouTube channel. We'll gather all those questions and hope to answer one of yours live on the air on Tuesday of next week. Also, go to StockChartsTV.com. That's our on-demand platform. I'm so proud of the team and the content, all of our great contributors sharing expertise during a challenging market time. Bear markets are fascinatingly difficult, but also a great opportunity to learn about market dynamics and risk management. We have a lot of great resources available for you for free at StockChartsTV.com, or on your mobile device, just search for StockCharts TV on demand. Our next segment is Power Up. What we like to do with some regularity is focus on one little snippet of the StockCharts platform, sort of help you understand what is telling you and how to use it. Today, I just want to focus very simply on our ChartSchool page. ChartSchool is a free part of the StockCharts website, and ChartSchool was one of the ways that I learned how to do technical analysis. I've been in the industry for about 22 years now, and have learned a great deal about technical analysis over my career. When I was first learning about technical analysis, one of my mentors when I was at Bloomberg pointed me to the StockCharts.com chart school. And I started to learn from people like John Murphy and Martin Pring, and I'd read their books. And all of a sudden, this was a way to take what they had shared in their books, but apply it to real market examples. And I was able to look at ChartSchool, learn about technical analysis, and then immediately start charting stocks and ETFs. And probably not a lot of ETFs at that time in the early 2000s, but mostly stocks and indexes. But I was able to immediately apply what I learned to the real-time markets. Just to orient you to what you have here, when you click on ChartSchool, you're faced with a question. How can we help you? This is a great place to start. Are you looking at a particular technical indicator? You want to understand a particular stock or ETF and a particular approach like money management? Just type in a keyword, and it'll help you find some of the articles that will point you in the right direction. If you're not quite sure what you need, just go through this list, because some of these are really, really valuable. And just to start with, the overview is the 101 version. This is the introduction to what technical analysis is. When I first read John Murphy's book, he talked about technical analysis being a study of price action, or study of market action, primarily through the use of charts, with the purpose of trying to anticipate what's coming next. And that began my journey of understanding market action and investor psychology. Going through each of these articles, it'll tell you some of the different tools and how to think about technical analysis versus fundamental analysis, how to apply it to your investment decision, whether the markets are really efficient or not. What about the efficient markets theory? All that is done. And I'll leave you with this. As you go on this first page, is one of the great hidden benefits in StockCharts. Go to ChartSchool, go to this first collection called Overview, flip down a little bit, and you'll have some fantastic reading. John Murphy's 10 Laws of Technical Trading should be printed out and hung on the wall of wherever you are when you're actually analyzing stocks. Irrational Exuberance, which is basically a review of Robert Shiller's seminal work, Irrational Exuberance, which talks really about behavioral finance and investor psychology, why bubbles happen and how they play out, is really helpful. And I have worked with a lot of my own clients over my career on cognitive biases, all the reasons why you make poor decisions or you're wired to make poor decisions. There's so much to dig into there. If you have some free time over the weekend, you're looking to upgrade your knowledge of your own investing decisions and of market dynamics as well, I would start with ChartSchool. There's so much there, all for free. Let's continue on today's show with the Final Bar Mailbag. Keep your questions coming to the Final Bar at StockCharts.com. Let's get to question number one. Microsoft has crossed through the 50-day moving average. So have many technology stocks. Does that mean the market has turned, or do we still have some room left? What about cryptocurrencies? Great question. Let's get to that. So if you look at the chart of Microsoft, here we go. So you sent this question about a week ago when Microsoft had actually regained its 50-day moving average. And I'm glad I'm reviewing the question now, because it's a great illustration of why you want to look at trends in a more of a holistic point of view. When I'm looking at a chart like Microsoft, I'm bringing myself back to my time at the Fidelity chart room, and we had this big room full of wall-sized paper charts. And one of my favorite parts of that space was you could stand right in front of a chart like we're doing with the chart of Microsoft on your screen and look in detail at the day-to-day price action, but you could also take a step back, take a couple steps back away from the monitor and just look at the longer term trend. What do you really see when you look at the chart of Microsoft? I see moving averages that had been going higher and now are going lower. I see the price above the two moving averages to below. I see higher highs and higher lows back here on the left half of the chart, and now lower lows and lower highs. Even though we've seen a bounce, even though Microsoft at one point regained its 50-day moving average, it wasn't enough to get above its most recent swing high. That's why I often talk about higher highs and higher lows and the importance of looking at those trends, right? You want to look not just at one day or one particular price movement, but how that fits into the big picture. By that benchmark, or by that, thinking of that and keeping that in mind as you're looking at the chart, nice rally for Microsoft, but not enough to get above the previous swing highs. For a stock to look more encouraging, for a stock to look more bullish, for the trend to be less negative, you need to stop making lower lows. You need to start putting in higher lows. You need to start making higher highs. So far, we appear to have been doing two of those things. The last low, if we look at Thursday, was a higher low that might actually hold and might be pretty encouraging. Again, assuming we don't make a new low going into next week. But at this point, potential higher low, which is encouraging. So we've stopped making new lows. We've actually put in a higher low. Now it's all about getting above the most recent swing high, which means Microsoft really has to get above like 270 to complete that rotation from bear market phase to bull market phase, at least on the tactical time frame. Now, when you do that, you always have to look for follow through. That's why the end of March was so crucial. We broke above resistance, but then never really followed through there. So I think some of these charts that have had nice rallies, some of the banks come to mind. Nice rally up to resistance though, but not through resistance. And that's what I would be looking for on the chart of Microsoft. I mentioned Bitcoin earlier, and I won't answer much more about cryptos except to say overall, I think those charts are still path of least resistance remains lower until proven otherwise. Can they get out of this congestion zone to the upside? Let's get to question number 2. Do you think the XLE, which is the energy ETF, is setting up for a bounce to the upside anytime soon? And you asked, actually had a number of questions on energy this week. Another one, particularly, you had mentioned you got in ExxonMobil and ConocoPhillips at a high price. Should I keep those positions and sell calls as a way to manage that? A lot of the questions dealt with just this challenge we have with the energy sector. Sam Burns from Mill Street Research was on the show on Wednesday. It was another really good conversation. We talked about commodities coming down. His thesis was basically we're not done yet. That commodities had been had their run. The high is in, and what I mean they're not done yet. They're not done coming down yet. That there's still more of a rotation to be had away from the commodity space and away from energy stocks. A lot of the energy names are starting to bounce or right at support at the 200-day moving average. The XLE looks like this. I want to say like DVN might look like this, and all these are a blur. Yeah, DVN kind of looks similar, but then you also have charts like FANG and others that have already broken down through their 200-day moving average, already making a new swing low, right? Sort of invalid downtrends now, again, of lower lows and lower highs. So I feel like the XLE is one of the last ones that will actually break down. The others have already actually done so. So when I'm looking at the XLE, I'm concerned by the downtrend that we've had. Could we have a bounce of sorts? Absolutely. I think energy stocks are caught up with the rest of the equity universe, which overall are in a pattern of distribution. I don't think the bear market phase is over for stocks. I will openly admit I'm wrong. If I start to see improvement and we see stocks breaking above their swing highs, improvement in breadth, improvement in sentiment, we haven't seen any of those things yet. By my trend following toolkit, trend is still down. So, would I expect any sort of bounce in energy? Potentially, but I would treat any sort of bounce kind of like the bounce you saw in June. I think that's a time to, make a short-term swing, and that's it. Might be a time to reinitiate shorts and bet on further downside to be had. That's my base case for energy until proven otherwise. That idea of selling calls, sort of a covered call strategy, that's a great one to do when you take on a position and you want some downside protection. I'm not sure if that's the best approach if you've already been registering losses. I would much rather, if you don't feel very comfortable owning the stock, I would much rather sell the stock. And that's an important thing to do. We call that the new money theory. If you had new money to put to work and we're looking at the chart of ConocoPhillips, do you see anything on this chart that would make you want to buy it with new money? If so, then I would hold on to your current position. But if you answer, heck no, that's a horrible chart, why would you have some of your current money in that chart as well? Go somewhere else, which is actually seeing a better price and relative return. Next question. When you said 31% of NDX members are bullish, what exactly do you mean by bullish here? I think you were referring to the bullish percent index chart that I was showing. That's part of my breadth chart list. So let me get there. I think it was this one we were probably looking at. Yeah. So this was the This was the NASDAQ 100 bullish percent. I'm guessing this is what we were talking about at the time. The S&P bullish percent index looked like this, which is closer to the number that you said, 31%. So maybe this is what you were referring to. But in either case, this is what I think this is what we were looking at. The bullish percent index is basically honestly, a lot of different breadth indicators you can make this assessment. You can say, based on this breadth indicator, 30% in this case are in a bullish pattern. And what this is basically doing is looking at the members of the S&P 500, all 500 charts. And imagine you're running a point and figure chart on every one of these names. And here's what the point and figure chart would sort of look like. Let's see, we'll do like Microsoft. That is super not the ticker, Microsoft. And we go to a point and figure chart. So this is what the point and figure chart of Microsoft looks like. So it's a column of X's, column of O's, and it goes back over time. The numbers represent the beginning of every month because this is purely looking at trend. X's are uptrends. That means we've made new highs relative to previous highs. Column of O's, if we move down enough, we go to the next column of O's, and that's a downtrend. So it's uptrends in X's, downtrends in O's. When a column of O's goes lower than the previous column of O's, that's a traditional sell signal because the downtrend is confirmed, right? When you have a new column of O's that goes below the previous column, a new column of X's that goes above the previous column of X's would be a new high. It would be a buy signal. That most recently happened here on the chart of Microsoft. So the most recent signal from Microsoft was a sell signal because you had a column of O's that went below the previous column of O's. We do that analysis that I just did on all 500 charts in the S&P 500 automatically. And basically only 31%, 32% as of today's close are in a buy signal, meaning the most recent signal was a buy signal using their point and figure chart. That's a traditional breadth indicator using point and figure charts. At this point, basically to register more of a bullish configuration, you need more and more charts like Microsoft registering a buy signal. As that would happen, as more and more stocks would register buy signal, this bullish percent index would actually improve. And that's where I'd want to see it get above like 50% and even ideally up to 70%, which is where it tends to be in more of a bull market phase. If you're looking for an all clear of sorts using the bullish percent indexes, that's what you want to see, because that tells you that more and more stocks that comprise those indexes are getting buy signals on their own individual point and figure charts. That is it for our mailbag. Some meaty questions in there, but I appreciate you so much sending them in. Keep them coming. We need to wrap today's show and go to the 3 and 3. Let's talk about 3 charts that tell the story of this market environment in just under 3 minutes. And here we go. Chart number 1 is a candle chart of Ford Motor Company. When we're looking at ticker F, this is a great illustration. I was sharing this with some of my Market Misbehavior Premium members earlier this week. So I had some questions on doji candles from some of my members. So I was sharing this chart with them. Doji candles basically represent indecision. So when you have a rally and then you have this chart candle that looks just like a cross, which means the open and close are right about at the same level. And then you have the high and low represented by the vertical line, which is called the shadow or the wick of the candle. That doji candle represents indecision. So if you have a rally and then a doji candle, that suggests that the rally is exhausted because there's not enough demand to push the price higher. If you have a downtrend and you see a doji candle, that says the downside pressure is exhausted. These are reversal candles, meaning if you see a doji after an uptrend, it tells you to expect a downtrend. If you see a downtrend and then a doji, you'd expect a bounce to the upside. Ford is a great illustration of the benefit of looking for doji candles. Also hammer candles, which is a beautiful signal on July 5th that this downtrend was most likely exhausted, demand coming in, and expect a bounce in Ford Motor Company. So thank you, Ford, for a beautiful masterclass in candlestick analysis. Chart number 2 is Netflix. Nice bounce today. Netflix is up 8%, but again, don't ever bet too much just on one day's return. 8% rally still doesn't put it above the most recent high. It's back above the 50-day moving average, but I think that's pretty low value. You need to get above 200 on the chart of Netflix to look really constructive here. It's worth noting that one of the FANG stocks has stopped going down. Many of them have, making a consistent low here, sort of a support level. Can it get above 200? That may be my question for next week. Finally, a chart I'm thinking about going into the weekend is a chart of the TLT, bullish momentum divergence. The RSI has been in a bearish range for quite some time. Do we get enough of an upside rally in bonds to get out of that bearish range, RSI above 60? That would be so key and might start to look more like mid-2021 with a rally in bonds and lower interest rates. Folks, that's a wrap for this week and the show, The Final Bar. Thanks so much for joining us every weekday after the close. Have a great weekend, and we'll see you next week.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.